Good morning, everyone, and welcome to today's jointly hosted webinar by myself, Samantha Manning at Searchers UK. And today we're kindly joined by Andy Crawshaw of Groundsure. Please, can I double check that everyone can hear me? If you can, please do use the chat and questions tab to let me know that you can hear me loud and clearly. Also, just to let you know that if you have any questions during the webinar that you would like to ask, or if you'd like any further information, please do let us know in the chat and the questions tab, and we'll be more than happy to answer any questions at the end of the webinar. Or alternatively, what you can do is contact myself or Andy after the webinar, and we'll be more than happy to help. Just to also let you know that this webinar is being recorded, and we will send out a copy of the recording after the session has ended. But for now, what I'll do is hand over to Andy Crawshaw, and I will speak to you soon. Thank you so much for attending.
Good morning, everybody, and thanks for that, guys. Happy New Year to you all, if it's even a bit too late to be saying that, but thank you for joining us today. I hope you are all fit and well. As I'm sure Sam has gone through, if you have any questions as we go through this, please add them in after. I understand there's quite a few people on here, so we'll get to them after the session. And there's some contact details for Searchers UK on the final slide. So this morning, we're going to have a quick look back at 2021. Which I'm sure everyone is glad to see the back of. We'll take into account the residential and commercial market and also have a look at what seems to be planned for this year. We'll have a look at what's happened and what the plans are for construction and planning, and also some other things to be aware of for 2022. But we'll start by having a look back at 2021 briefly. Now here's a timeline of events. As you can see, in January, it saw us enter our third national lockdown, and then kids were sent back to school in March, and I'm sure I wasn't the only one who did a little jig of joy at that news. The pubs opened fully in May, another little dance for everyone, especially for Boris, who threw quite a big party for it. And we here at Groundsure, we launched our new residential reports in July. There was more dancing for everybody involved here at the end of September when the stamp duty holiday ended. I'm still not sure why they called it a holiday. And then, as you can see, the Omicron variant reared its ugly head for the first time in November. So quite a busy year for everybody. But we'll have a look at the residential property market. And on your screen are some comparison figures from the great people at 20CI. And this is comparing 2019 versus 2020. You might find it a bit strange comparing 2019 to 2021, sorry, but 20CI have foregone a comparison with 2020 just due to the turmoil that the pandemic delivered. Instead, they have compared Q3 2019 with Q3 2021 just to provide a base that reflects a near-normal market and also conditions that were there pre-COVID. And it just provides a more realistic or normal idea of market conditions pre-pandemic. As we all know, the residential property market has been incredibly busy, and we've seen volumes through the roof since the property market opened in May 2020. This was helped along by the SDLT holiday, which I'm sure everybody is pretty happy is over. The momentum within the residential property market has continued to deliver a significant volume of activity since it reopened in May 2020, and also that introduction of the stamp duty holiday. So we're seeing a conveyancing logjam easing at the minute. The average time from a sale being agreed until a purchase completes has dropped from an average of 154 days in July to 127 days in October, and hopefully we'll see that continuing to get even shorter. The average time between 2017 and 2019 was 3.5 months, or 104 days. So although conveyancing times haven't fully recovered yet, the time to find a buyer is at an all-time low of 37 days nationally. This means that the total time sellers should be allowing is 5.5 months. The people at Rightmove estimate that the number of homes currently going through the legal process is around 550,000, and that's less than the 700,000 recorded in June, but still 41% higher than October 2019. 2021 saw nearly 1.5 million transactions, and that's the highest number of sales since 2007. And this was 47% higher than in 2020 and 31% higher than in 2019. The government target for returning local searches is a maximum of 10 working days. Recent turnaround times revealed that some local authorities are taking between 35 and 60 days to return searches. And also the government is currently working on the digital service roadmap, which can't come soon enough and should better some of these waiting times. HMRC's aim is for the property market to be perfectly informed by digital data, and where customers can receive an outstanding, wholly digital service and transactions are secure, near frictionless and resilient. It will also mean that the financial value of a property is easier to realise, and digital property information is easy for all to use in the support of private and public sector services and a sustainable future. So the average asking price across the UK in Q3 2021 was £388,000, and that was compared to £345,000 in Q3 of 2019. That's an increase of 12.5%. With a sustained high level of sales agreed and no significant increase in properties coming to the market, the lack of available properties is continuing to drive up prices as demand currently significantly exceeds supply. Every region of the UK has experienced an increase in average asking prices, albeit in London seeing the lowest growth, reflecting the significant impact of the pandemic on the capital. Property prices have been able to climb for home sellers since May 2020 because the level of demand has far outweighed the influx in supply. With less properties on the market to choose from, and with greater competition from other home buyers offering above asking prices, home buyers have had no choice but to also offer inflated prices, and then this shift in power between the sellers and buyers have determined a new market position. So this is the result of the ongoing national re-evaluation of housing. There's also low mortgage rates and the additional boost from that extended stamp duty holiday. The strength of market conditions are not a result of the stamp duty holiday alone, and greater forces are shaping the market. This is evidenced by the fact that there has been no sign of any cliff edge in demand for homes, which continues to run 25 to 30% above the 5-year average since last summer. We saw 2021 as a record year. Sales exceeded the highs of 2007, and there was over £473 billion worth of new sales agreed, and that's 95 billion higher than 2020. As I said, there's no sign of any cliff edge in demand. The impact of the pandemic on activity is further to run, albeit at a less frenetic pace, so we'll see what happens there. And then there's also further room for above average price growth in most affordable housing markets, where the current rate of growth is the highest. According to The Guardian, who had a look at the nationwide index, the UK prices returned to double-digit growth in November. That was up from 9.9% in October. And house prices have continued to go up as demand has stayed strong, even after the end of the SDLT holiday and the end of furlough. The average UK house price rose by 0.9% last November, and that's according to data from the Building Society nationwide. And this was after we saw an increase of 0.7% in October, and it takes the average UK property value to £252,687. Average house prices are 10% higher than a year earlier, and house prices have risen to almost 15% above levels that we saw in March 2020, and that was when the coronavirus pandemic first struck the UK. The continuing rising prices appear to be part down to the reduction in the supply that we've mentioned. The October property market was the quietest for almost a decade, and according to data from HM Revenue and Customs, sales were 28% lower in October than a year earlier, after a record surge in activity earlier in 2021. And then we've got the figures from the Bank of England, and that showed that the number of mortgages approved for UK house purchases fell in October to the lowest level in 16 months. And Nationwide are also saying that this cooling off was almost inevitable. That's after the stamp duty holiday in England and Northern Ireland finished at the end of September, And as we all know, buyers were rushing to bring forward their purchases just to take advantage of the tax break, which also made larger homes with bigger gardens more popular. People seeing the effects of the pandemic and obviously wanting to move to more rural areas, which we'll talk about in a second, but also have a bit more outside space to enjoy in case anything like that happens again. So just talking about property stock again, compared to Q3 2019, there are 9% fewer new instructions, whilst sales agreed are 16.5% greater. And as we know, demand throughout 2021 consistently exceeded supply. If anybody else is actually looking at properties or got alerts from the property portals on the phone, you'll notice that these are dripping through a few a week, where it used to be a few a day. So aside from inner London, the whole of England and Wales at a regional level has between 1.7 and 2.5 months of property stock left to sell. And overall, the available months of stock are down by about half on historical norms. Without a significant uplift in the volume of new instructions, the residential property market is at risk of a slowdown this year. There's also clear evidence of a slowdown in the rate of price inflation. Demand for homes has not been uniform over the last 18 months. Analysis shows that the mix of home buyers and pricing of homes sold has shifted markedly over this time. Then the mix of buyers is starting to return to normal as the economy reopens and mortgage availability improves. So we'll move on to have a look at the commercial market. And the strongest downward shift in prime yields during 2021 has been in the sectors that have seen the largest year-on-year increase in investment activity, with industrial and logistics volumes for the 11 months to the end of November being 36% higher than the full year in 2020, and retail warehouse investment volumes 40% higher. Looking to 2022 and beyond, it's expected that we'll see enthusiasm for prime assets at high yields that drove retail warehouse activity last year to spread to other parts of the retail market. Further yield hardening in London offices and national logistics is harder to rationalise, though it may happen due to sheer weight of money. However, if these trends continue, then the huge spread between the returns on offer from industrial and those from retail could well close. As the chart on your screen shows, retail has gone from the worst MSCI total. Investor sentiment in the industrial sector remains high, as by the end of Q3, volumes had reached £12 billion, and that already exceeded the previous annual record of £10.9 billion, accounting for 29% of the total market, which is again the highest ever level. There could be an issue where new planning policies will increase costs to logistic developers. Climate change is a focus for many industries right now, and none more so than the development industry. Buildings currently contribute some 19% of global greenhouse gas emissions, but this could treble by 2050 if action is not taken now. This is according to the Intergovernmental Panel on Climate Change Research. New development will be forced to take on more of a share of ambitious targets, and the planning system will be key to enforcing such targets. Local authorities will be central to the functioning of the new duties being imposed by the government through the forthcoming Environment Act. From the commercial market, the biggest question for 2022 is around offices, but the forward-looking indicators are positive for the markets outside London in particular. While the latest data on average office occupancy across the UK doesn't point to a surge back into the office, there are definitely signs that tenant demand is poised to recover strongly in 2022. The average occupancy in UK offices in the week ending 26th of November was 23.3%, the highest level since the start of COVID, and this peaked midweek at 27%, with a consistent trend now established that Tuesday, Wednesday and Thursday are the busiest days of the week. So we'll move on to construction and planning and have a look what the plans are for the next year and also for 2023. So construction activity has recovered strongly since the start of 2021, And this was when the vaccine rollout happened and progressive unlocking of the economy started, and this started to rebuild confidence within the market. The value of underlying project starts during the 3 months to May rose by 20% and was 70% higher than when the UK was in the midst of the first national lockdown. After this sharp initial upturn, a steadier progressive strengthening in project starts is anticipated over the forecast period. This year, it's expected that the value of underlying starts, so projects with a construction value of less than £100 million, is to total 54.2 billion. That's 3% above 2019 levels. However, the recovery will not be evenly spread, with regional and sector champions and laggards reflecting a changing UK economic and social landscape. In addition, the current shortage of construction materials highlights the potential impact of supply-side constraints on the pace of that recovery over the next 2 years. And talking about construction materials, the table on your screen shows the materials that are used in construction and the percentage that are imported. The combination of COVID and Brexit have caused major disruption to the supply chain. The limited availability of a diverse selection of construction products has prompted concerns over industry capacity and the cost and timely delivery of projects. A company called Glenigan, who deal with planning applications and also the construction industry and looking at the data and how they put it together, they predict that current shortages will ease this year as manufacturers' operating levels rise and the current disruption to global logistic networks dissipates. Post-Brexit structural changes, however, are expected to reduce the ready availability of EU-sourced products. Domestically produced construction products account for the vast majority of materials used by the UK construction industry. However, imported materials totaled £18.1 billion during 2019, and that accounted for 24% of construction products used in the UK. Overseas source products account for a high proportion of some materials, including timber, electrical wires and fittings, and plumbing and heating equipment. Extended lead times and restricted product availability in these areas can have a disproportionate impact upon project schedules and costs. The Ministry of Housing, Communities and Local Government will now become the Department for Levelling Up, Housing and Communities. This programme, the Levelling Up programme, is one that's been set out by the government to reach tangible improvements in every part of the UK, just as we try to build back better, as they say, from the pandemic, and also deliver on people's priorities. In response to the widening of socio-economic divisions during the pandemic, the government has reaffirmed its commitment to levelling up. While much of the focus of levelling up has been on road, rail and regeneration, according to PricewaterhouseCoopers, 70% of the public say that a focus on housing would be the most effective way to level up the country and reduce inequality, and they rate quality almost as highly as affordability. In the last year, the pandemic has forced people to lead their lives much closer to home. For some, it has been a welcome opportunity to spend more time in their homes and communities. But for those with small, substandard homes, it's brought to the fore long-standing issues of affordability, equality, and also the quality of their homes. The programme of investment in creating new affordable homes looked at a reminder of the many initiatives currently in place to support new housing. Robert Jenrick's First Homes Plan is currently underway, with Mr Sunak pledging 20% increase on the previous investment programmes. £11.5 billion is to be set aside for new build homes, and a £1.8 billion commitment made to unlocking 1,500 hectares of brownfield sites to help deliver 160,000 new homes. And that's something that's music to our ears at Groundsure, as we love the idea of developing brownfield sites and leaving greenbelt land alone. Areas outside London are planning to get a bigger slice of this £11.5 billion pie. Last year, the government revealed that it would be handing out £7.5 billion of the Affordable Homes Plan to fund affordable housing development outside of London, and that's an increase of more than £3 billion when compared with the last round, and it will see non-London areas receive around 65% of all funding, whereas last time it was about a 50-50 split. And then there was the planning bill that was announced in the Queen's speech last May, and this aims to boost development and hit housing targets of 300,000 new homes built per year. It's a number we've heard bandied around for many years, and it's never been a number that has been hit. But local authorities will now have to classify all land in their areas as either growth, renewal, or protection. This will mean that areas classed as growth will get automatic permission, areas classed as renewal will get permission in principle, and areas classed as protection equals no build. So let's have a look at what we've got to look forward to for this year. If we have a look at the residential forecasts, and I'd just like to make a disclaimer now that it really depends on who you talk to as to what the predictions are, and they do vary. Nobody has a crystal ball, and at this rate, given the new Omicron variant, nobody really knows what impact it's going to have on the wider economy. So we'll have to wait and see. But Zoopla have done some research, and they forecast a 3% increase in UK house prices over the course of 2022. This is across a predicted 1.2 million housing transactions. So they say that more than a fifth of households, 22%, plan to move over the next 18 months. And this is as a direct result of the pandemic. The people more likely to move were younger people who live in cities, suburbs, or large towns, and people whose working patterns have changed permanently. There's been a lot of reassessment of people's lifestyles and a re-evaluation of housing needs. Following this change in working patterns, we're likely to see a continued move to other cities and towns, with some still wanting that rural lifestyle. According to Zoopla, the main drivers for the sector will be an ongoing re-evaluation of housing needs, increased housing equity, and moves in parts of the labour force to a more hybrid working. As always, there will be polarisation across the country, with the biggest price hikes expected to continue in the North West's housing market at around 4%. London remains the slowest part of the country, with rises forecast to be around 2% over the year. The increases forecast overall are a bit more sustainable. Right now, towns such as Blackburn and Rochdale in the northwest are seeing price growth of more than 10%, and places like Liverpool and Manchester seem to be leading the country with annual house price rises of 1.4% and 8.7% respectively. The Bank of England base rate increase to 0.25% will more than likely have a knock-on effect on mortgage rates, and it's one of the reasons buyers who were on the fence about buying are actually being spurred on to invest sooner rather than later. If you then go and have a look at Savills and what they've forecasted, they looked at specifically around the Greater London area, and this was in an article published in November. They're saying that as international travel gets easier, the number of buyers looking at purchasing property in prime central London is going to rise and will likely have a big impact on the market this year. If interest rates and taxes rise, it'll slowly squeeze people's spending power, which could soften the rate of house price growth. And given how strong the price growth has been in the last few years, it's bound to happen. And as much as I hate to even talk about 2024, we do have a general election year coming up, and that can and does impact markets in and around London. Long term, the price difference between markets like the southeast of England, Scotland, the Midlands, and Northern England really means there's more growth capacity for the latter, and Savills predicts that it's areas like Northern England and the Midlands that will top performing regions in the next 5 years. If again we have a look at 2022, the outlook of price inflation and overall sales volumes is a balance of positive and negative influences. On the positive side, housing remains affordable in many markets, and competition amongst lenders will remain intense, even if mortgage rates increase. A continued scarcity of homes for sale will remain well into 2022, in Savills' view, and this will support headline price inflation. In addition, analysis shows that the impact of the pandemic on home buying decisions has further to run. It's now clear that the impact that this has had on the UK housing market was not going to be short-lived, And it is thought that this impact, as it runs into 2022, will support market activity and sales volumes. The primary catalyst will be an ongoing re-evaluation of housing needs, increased housing equity, and moves in parts of the labour force to a more hybrid working, as we saw that with people working Tuesday, Wednesday, and Thursday a lot more. But Zoopla Research recently conducted a national representative survey of UK households, which found that 22% remain eager or very eager to move homes in the next 18 months. And it is important not to overstate the impact this pandemic has had. The same survey found that 60% have stated that they are making no change at all in their motivations to move, which isn't really surprising. Hopefully, all the lockdowns that we've seen are behind us, and that shift to hybrid working for many office workers is going to be the way that people choose as and when they move home and what to. We also see from Zoopla that they're saying that we saw record sales in 2021 and that they expect transactions to decline by 20% to 1.2 million in 2022. This is in line with the long run average, but still relatively high compared to the sales volumes over the last decade. And also something that I'm sure you guys are aware of, but AP1 submissions will need to be submitted digitally from November, hopefully saving everyone time by reducing requisitions, automatically calculating fees, and also auto-populating some sections of the form. So hopefully everything will be in place for November, and it should save everybody a bit of time and effort in actually submitting those AP1 submissions. And then there's the land registry fee increases that happen at the end of this month from the 31st of January. And you can find out the differences of these increases and the different scales and the application types on the government website. If we have a look at the outlook and what to expect from commercial, construction output is forecast to rise by 13.7% and a further 6.3% in 2022, despite this shortage of materials and also price rises that we've been seeing. Infrastructure output is expected to rise by 23.4% in 2021, and that's thanks to major projects including the nuclear power station at Hinkley Point C, the Thames Tideway Tunnel, and High Speed 2, whatever they decide is going to happen with that, we'll have to wait and see. Weak UK growth and the disruption to UK business revenues and confidence deters private sector investment in most non-residential sectors. That's what we're looking at for 2022. There's also weak real earnings growth, together with tax and interest rate rises. This will check housing market turnover and curb the rise in private housing building activity over the next 2 years. An increase in public sector investment is forecast to support the recovery in construction activity. Funding commitments in the spending review are expected to lift government investment in areas such as health and civil engineering. Then post-Brexit customs regulations and non-tariff barriers continue to disrupt supply chains, and that's both for the construction industries and across the wider UK economy. Brexit and the pandemic have also intensified the labour shortages, both in construction and supporting industries such as logistics, and also things like agricultural work as well, which we've seen down in the southwest especially. This is expected to disrupt the economic recovery from the pandemic. The strength of the initial recovery in construction activity did throw a spotlight on the impact of supply-side constraints on the pace of growth. We expect supply-side issues to temper the pace of growth over the forecast period. Near-term availability and cost of materials are set to be the greatest constraint on industry growth, and these are anticipated to ease during 2022, while labour availability and wages are expected to be a growing supply-side constraint. And then greater public sector investment will fuel recovery in social housing, health, schools, and civil engineering. That's everything from me. Thank you very much for your time today. I hope you found some of that useful. But thanks again and enjoy the rest of your week. Thank you.